Thanks for that introduction, Paul. I appreciate it. My name is Vivek Chandra. I'm the CEO and founder of Texas LNG. And today I have a few slides to talk about what I call the unique position of US LNG. After my quick presentation, I think that Luke will be doing his presentation, and we'll open up for some questions. So I look forward to receiving questions from both Luke and Paul, as well as from the internet audience. So before I get started, I heard an interesting, fun little story the other day. Someone mentioned to me that I don't know if it's true, but I'm assuming it is, that when Albert Einstein, he was actually towards the end of his career, was a professor at an American university. And he had just given a test, a physics test, to his students. And as he finished the test, he gave the test and he was walking out of the building. One of the students came up to him and said, "Sir, do you realize the test you gave us had the same questions that you gave us last year?" And Einstein looked at the student and said, "Yes, the questions were the same, but the answers were not." So I think that's a unique, that's an apt way of looking at the marketplace today. Though we have many similar kind of events happening, the reasons behind them are quite different than they may have been in the past. So without further ado, let's get started. I'm going to go to the next slide here. So a couple of things that I want to talk about today are what I call my 4 hypotheses. And some of these will be interesting, I think, for a lot of you. They could be a little bit controversial. But the first one is that what we read about in these papers and the hype around the LNG trade press about spot prices, we cannot rely on those spot prices to be making sweeping market judgments, especially judgments about what we think the longer term price of LNG will be. The secondly is that the recent news about the cancellation of US cargoes, it actually, in my view, demonstrates the strength in the US model, not the weakness in the US LNG industry. And I'll try to explain that as we go further. And I am firmly convinced that when supply-demand dynamics normalize, whatever normalize means, that we'll see the spot price revert back to what is going to be equivalent to a full US LNG cost, as opposed to what's happening right now, which is a marginal US LNG cost. And I'll explain that further as well. And I'll end with a quick discussion about the fact that US does have a lot of projects waiting to get sanctioned in what we call the second wave. But not all these second wave projects are equal, and only a few of them will actually reach project sanction. Yep. So there's been an incredible amount of media, both inside our LNG industry as well as outside, about the spot price of LNG and how it's now, $2 or $3, and that is equivalent to a wellhead price in America, etc., etc. And we can all get very excited. But I think it's really important to understand a little bit of what we are reading. Most of the time, the media is quoting a JKM price. The JKM is a price created by Platts, which is obviously a well-known reporting agency. And my understanding is that Platts gets this price, an indication of price, from its sources and what people report to them and its own internal intelligence. And every day, I guess people call in or write in or send emails to Platts by a certain time of Singapore. They then coalesce these prices and they come up with what they think the JKM price is that day. Now, it is at best an indication of spot price. It is not directly linked to any particular cargo, ship, contract, buyer, seller, etc. It is an indication of what Platts think the price is that day. It can be highly skewed by individual trades, and I know people talk about how they try to game Platts. I'm not here to say whether that can or cannot happen, but the fact is people report, and Platts has no way of checking whether that's real, except from talking to many people and giving their own assessment whether they think that's a correct price. And that price has no mathematical link to the majority of cargoes that are delivered into these markets, because 70% is the number we always have used of cargoes are still delivered under long-term contracts. And these long-term contracts are, of course, not covered by this JKM price, because A, they're confidential, B, they're delivered under 10, 20, 25-year contracts between buyer and seller. C, they tend to be, a majority of them at least, tend to be oil price linked because a lot of these contracts were signed the days when that's all we had. A lot of these contracts are still very strict destination restricted contracts, so the cargoes have to go to those buyers no matter what. And these prices, these long-term contracts, these cargoes continue on a regular basis. There's no incentive for those buyers or sellers to report any price to Platts or anybody else. Now, actually, 70% may be a low number, as we have seen demand come down in Japan and in Korea and other countries. Buyers are more likely to continue their long-term purchases and cancel any spot cargoes they had planned, because these long-term purchases, canceling them will cost them penalties. So that 70% that is delivered by long-term could actually be, over the last couple of months, even higher, and thus even reducing further the relevance of that JKM price. Another thing that's interesting, that JKM, though it stands for Japan Korea marker, it actually includes China and Taiwan. And recently, more spot cargoes are going to China and Taiwan, especially China, than anywhere else. In fact, 50% of the cargoes, at least in my estimate, of spot cargoes are going into China. And so that skews our understanding, our estimate of what the price is in Japan or Korea, which tend to be the longer term markets for a lot of these cargoes. So we have to understand that first, the Chinese economy has rebounded faster than some of the others after the virus. And so they are buying a lot of cargoes, and they're buying a lot of spot cargoes. And so those spot cargoes, they're getting them at a relatively low price, and that may be also skewing the JKM price. So be careful about using that, and be careful about assuming that the JKM price is actually the long-term price. And in fact, chart here, this is from Cedigas, which is the French reporting, data analysis company of gas, and they come up with some really good data. It actually shows a couple of lines, and it just came out, but it is the latest data on this chart is actually end of 2019. And what I want you to look at is the green line color line. That is the long-term Japan contract average price. That will be a very good indicator of what the long-term price of cargoes are into Japan, and still around $10 all of 2019. And yet the purple line shows how the spot price into Japan has come down to maybe $5 or $6. So you can see that, if there's any kind of a link between spot and long-term, it's hard to make just looking at this data. It's hard to see why there would be a connection between the two things when the long-term tends to be, as I said, a large proportion of the long-term contracts are oil linked. There could be 20% or so could be Henry Hub or US linked, but that price has stayed relatively constant as opposed to the spot price, which has come down. So, if oil prices have also, and in the last few months, oil prices have also come down, so we can expect a weakening of the long-term price. But the long-term price tends to have an average 1 month, 2 month, 3 month backward-looking oil price linked to it. So it will come down in 2020, but maybe not as dramatically, or for sure not as dramatically as that spot price will indicate. So again, goes to the point, be careful about just assuming the spot price is the price of long-term, and that's going to be the price in the next month, 2 years, 3 years, whatever. I think we have to be careful, because the spot price is likely to rebound faster than the long-term price will change. And in fact, that's a nice segue into the next slide. This is a very recent report done by Morgan Stanley. And I want you to look at the graph. The orange part of the graph is actually the US hub price, and in this case, Henry Hub. The little band above that is the feed gas that you lose for the compressors, because most of the American projects, not Texas LNG, but most of them use gas for their compression. So they use a little bit of gas in the plant. And the blue is shipping to Asia. And you can see that since about January 2019, there's a high degree of correlation. In fact, Morgan Stanley calculated 0.81 between the JKM price that we talked about earlier and this marginal US gas price. This marginal price again is Henry Hub, the hub price, the feed gas plus the shipping price. So you can see that, since the last year and a half, the JKM price is following the US marginal cost. Now, before then, it was much higher than that, and actually the gap between the JKM price and the US marginal cost was about $2 to $3 or even more. And that to me, I think approximates the US liquefaction. So my hypothesis is that before 2019, the JKM price was the US full price that includes the hub price of feed gas plus the losses in the plant plus the shipping plus actually the liquefaction cost. This is the cost that the liquefaction plants, Cheniere, Freeport, etc., would charge for liquefying the feed gas into LNG, and that's a reflection of the capex of the plant. So as we see supply demand kind of dynamics go back to normal, I would expect JKM price to go back up, and it'll go back up to US full cycle price. So now why US price? Because the US is probably the most flexible tanker that can come into Asia. And so the spot price would naturally revert to that price, because if there was more of a demand for spot cargoes, if at the ceiling, you might say, that tanker would come from the United States because they have the most amount of flexible cargoes. Another thing that's quite interesting is, of course, is that a large proportion of US long-term contracts are held by trading companies or by entities that bought them to resell them into markets such as Asia or Europe, and they're not end users, while a large proportion of customers of Australian projects, of Qatari projects, other projects are end users. So they're less likely to trade into the spot market, a large volume, while the US customer has a lot of volume to trade. That's what he wants to do, and that's why that marginal price, the spot price in Asia could revert back to the price that customer would have for their full cycle that they pay Cheniere for, that they pay Freeport for. In fact, Cheniere itself is a trader into this market doing exactly this. So hopefully that gives you some spot to say why the US is actually quite a driver into the marketplace. So just to I need to speed things up a little bit, but it's important to realize that, people are talking about canceling US cargoes. It's because US cargoes can be canceled. When you are an Asian buyer buying from markets from other suppliers such as Qatar, etc., it's very difficult to cancel your cargoes. You typically have strict take or pay, and you have to pay the full cycle, and you have no visibility what that cycle is. You got to pay, if it's a DES contract, you got to pay shipping, you got to pay the liquefaction, you got to pay the pipeline, the upstream, everything, but you can't break that down. You got to pay the full amount, so you're less likely to cancel. The beauty of the American model is, whether it's tolling or otherwise, it is more flexible. You can actually say, listen, I do not need a cargo next month. I'll pay the liquefaction, because that typically is your take or pay on liquefaction, but you can cancel your feed gas. You can resell that feed gas into the American liquid market or the marketplace. You can even turn around your pipeline contracts in the US. And if shipping is on, shipping market is relatively liquid as well, and you may be able to even defray some of that transportation cost. So the reason we are canceling cargoes is because the demand looks lower than people expected. The reason we are canceling US versus other cargoes is because the US has that very, very flexible model. So for a customer, as we go into a very volatile, uncertain marketplace the next 5, 10, 20 years, I would venture to say you want to buy more of this flexible as opposed to the inflexible, and you want to buy more from the US. So that's my last slide. Coming up is, why is Texas LNG interesting? I think, there's a lot of projects in the second wave, the US second wave, but as customers, they should be really looking at a few things. They want to make sure that that project is the right capacity. These large 10, 15, 20, 25 ton projects are just not going to find customers in today's tough marketplace. So it's unrealistic, in my view, that these projects can get sanctioned even beyond their minimum threshold, which may be 10 million tons, because that customer is very hard. It's very hard to find customers at 10 million tons in today's marketplace. People want to diversify. They want to buy 1 million ton from many different places. They don't want to buy 3 million tons from one place. You want to have access to feed gas, of course, that's very important. And Texas LNG has access to the prolific Permian, which has been trading at much lower than the Henry Hub price. You also want to be close to the open water. You don't want to be too far into the 30 miles inland, because that's just going to add to shipping costs as well as uncertainty and risk. And you want to use tried and tested technology. So I think that there are a lot of projects in America ready to get sanctioned, but I think that not all of them will. And Texas LNG has all the right attributes to be one of the projects that get sanctioned. We're hoping next year, and first gas in 2025. So with that, I will turn it over to Paul, I guess, who will then give it to Luke. Thanks, everyone. I look forward to your questions.